All right, let's start. So on the exam, what I'll do on the exam is the average was too low, but the median was too high. So whatever I do, I want to raise the average, but not affect the median. So for anyone who really bombed the question one, I'll let you resubmit question one for up to 70%, which means if you made 72, it's of no value to you. All right. So if you made a 40 on exam one, question one, you can get up to 70. What that does is it's going to bring the average up probably closer to the C+ level, which is what I'm looking for. And it gives those people at least a chance for a solid B in the class if they can, do better. And the second exam is a lot different than the first exam. Some students really prefer the second exam because it's almost all math and problems, and you got a YouTube for every math problem. So, so any questions on that? On the second question, boy, I try to make it as clear as possible, but just for your interviews, if you're saying I want length and duration, you say I want a length and duration because we're having a recession, what's missing in that comment? Why do you want a length and duration in a recession? Because interest rates are doing what? In a recession, you expect them to fall. All right, so you have to say that. So if you say I want to get more duration because we're expecting a recession, they'll kind of understand what you mean. But the boss said they expected rates to fall, right? It's a little confusing because short rates are going to come up, but long rates are going to come down. So you have to be kind of, some students got a little confused on, well, the short end's coming up, but if the short end's coming up, the long end doesn't necessarily have to come up. The 10-year treasury is technically, you can back and test this, but the 10-year treasury is essentially 10 years of future fund rate, Fed fund rates. So essentially the 10-year rate should reflect what people think the Fed fund rate is going to be over the next 10 years. So they should be related, but they don't have to be perfect related. And the Fed funds has been so low for so long, you can come up without the 10 moving, so if you're talking about lengthening duration, you want to talk about interest rates going up or down, right? If you're talking about quality, that's where the recession comes in, right? So just being clear on those kind of things, but so we'll see if you get these kind of interview questions. It's just somewhat what they're looking for is your knowledge of how markets work. I'm doing the Bloomberg market concepts right now. It's actually pretty decent. There's a few places where I think their examples are a little bizarre. I'm not sure why they would do certain things, but for the most part, it's pretty good. So if you haven't done that before, that's a good refresher to make sure you're getting these concepts. Money and banking, y'all may be taking that this semester. That's like a really critical class to understand how the Fed works, what tools they use. Are they talking a lot about QE and money and banking these days? Are y'all taking that now, or is that next semester or last semester? They're going to now. They're doing a lot on QE.
No, not yet.
Yeah, because in my time we didn't talk QE at all, and why is that? No one had thought of it before, right? What's QE? They wouldn't have no idea. If I'd said in my money and banking class, what about QE? They say, what does QE stand for? They wouldn't have any idea. So we've done so many bizarre things in the last 10 years that we'd never thought of before. So your money and banking is real critical because the Fed is so central. And that's why I like the Bloomberg market concepts. They spend a lot of time on the Fed and what the Fed does, how it influences things. That's really pretty critical to understand. And y'all have seen how the Fed has really moved markets these last few years. Not just by them actually changing rates, but by them just saying what they're thinking about changing rates. I mean, it gets to the point where people were taking Fed statement last quarter and this quarter and comparing it, and what word did they change? And that by itself with blue markets, 2-3% is pretty amazing. I remember in 2008, we had a new Fed Treasury, no, 2009, a new Fed chairman, no, Treasury Secretary. And he said, I'm going to talk to markets and we're going to clear up a lot of things. So I'm watching the stock market while he's talking. And he says he's going to give details. He gave no details. Every time he said a word, the market just kept falling and falling and falling. We're like, I wish he would just shut up and leave because he's He said he was going to tell us stuff and he's not telling us anything. And so markets cling on these words and what's going to happen with rates. So, so if you find that boring, what do you need to do? Change majors, right? This is so central to what we do. It really is pretty amazing. Okay, let me find. Let's see, where did I put that file? I must have put it here. Just a second. There's a file I want to show y'all. So I built this file for you for paper 2. So you can start working. I can't remember when paper 2 is due. I don't think it's tomorrow. So when is it?
Next Friday.
Next Friday. So you got 2 weeks. So it's not that lengthy of a paper. So you can certainly start working on it. So yeah, BBBY, I gave you their comp number, the previous year, the estimate. Those are the numbers that you need. The surprise, I got the revenues, the comparable, prior year, the estimate. I even blocked these out just to prevent y'all from talking about them. So no one in finance talks about the estimate from last year because it's just our forecasts are so bad, we just don't care anymore. I gave you a gross margin, current versus estimate versus last time. I even converted it into basis points for you, although I'd rather you do that yourself, but I did that for you. Then you got the EBITDA margin. It's off here to the right, so you have to look for it over here. So this is actually EBITDA over here. I gave you the stock price. I don't like how I did it. I wish I could redo it, so you might have to redo this yourself. I clicked for overnight, and it doesn't look so good. If you take the overnight out, it's a much better looking chart. But you need a chart on your stock, and I encourage you to create your own. And you can certainly do that using Bloomberg. All you do is you go to, this is the GIP function. It gives you the intraday price. And if you do the GIP function and you do it, and I gave you the dates, so you know what dates to do. Can you tell where they reported earnings? Pretty obvious, isn't it? And when did they, so they obviously reported earnings before open on this day, on the 30th. You can just tell, right? And how did the market react? Down 24%. That's not a strong. And did the market change their mind after that initial reaction? Not much, right? So that was pretty telling. BLK, you'll notice with BLK, there is no gross margin. And why is that? Investment firms don't have gross margins. It's a very different business, so you can't really talk about that, but you do have an EBITDA margin. There's the stock. Can you tell where they reported? Overnight, and here's the morning. So the morning of the 13th, they reported, and the market had a favorable reaction to that. A CarMax. Now this is an interesting one, right? This firm should be doing wonderfully well when you have used car prices up, what, 42%? I don't think we've ever seen that in history. Just crazy stuff. So their earnings is, man, you can just look back historically, their earnings, but it's just crazy stuff. Man, look at that number. Is that the highest earnings they've ever had? 263. It's got to be. So just amazing numbers. I mean, look at that from going last year to this year, 3 cents to $2.63. But then they drop back here a little bit. Their revenue actually beat. So that's always interesting when they miss on earnings and you beat on revenue. There's something going on. That tends to say that there's a margin issue, right? Because their revenues are fine, but they miss on earnings. Obviously, their margins were thinner, so some expense is going on. Then you look at gross margins where they missed by a bunch on gross margins. So there's something going on. Their cost of goods sold is because they're having to buy used cars that are more expensive. They can't. Have y'all tried renting a car in the last year? My brother, I got him, he and his wife, a travel gift. And when I told him how much, I said, no, that's too much. We don't need that. I said, well, you go budget. And sure enough, he goes, oh, the rental car. It's kind of expensive. Yeah. That's why I had to add a little bit more money to it because it's really expensive. So they missed on the margin. And last year's margin was just incredible. Their EBITDA margin, go off to the right. They missed on that one and below last year. And then the stock price, can you tell how the market reacted there? It's pretty obvious, right? You can just see that big drop, very negative reaction. Delta, obviously coming out. I mean, these are just ridiculous numbers, aren't they? How do you survive when your revenues drop 80%? Isn't that just, if someone had said that in 2019 to the CEO of Delta, said, my forecast is your revenue is going to drop 80%. And you're working for Delta in finance, they probably would have fired you, right? So, man, where do we get this person from 80%? Just crazy, crazy stuff. Well, let's see if it was 80%. It was 11 to 2. That's a pretty good drop. Or 11 to 1. That's a pretty good drop in revenue. Have they gotten back yet? I mean, that's some of the things you can talk about in your paper. I haven't assigned your companies yet, so I want to do that today. So there's their EBITDA margin. I don't have a gross margin. Airlines, depending on your source, airlines don't have gross margins. Now, if you go to Yahoo Finance, they do have a gross margin. But Bloomberg does not report gross margins for airlines. I don't know why that is. So all I have is a net margin, and there's the stock, all right? Same thing with Goldman Sachs. Does Goldman Sachs have a gross margin? No. What would you use for Goldman Sachs? Anybody know for banks? Instead of gross margins, you would instead talk about what? Net blank margin. What do banks use? The net blank margin. Net interest margin. What is the net interest margin? What you earn in interest on your assets minus what you pay in interest on your liabilities. That's what a bank would look at. But Bloomberg doesn't report that, so I couldn't bring that data in. Could you talk about it in your paper? Yeah, obviously, you definitely could do that. All right, so let's assign these. I gotta find it again. I never know where I file stuff. I should get better at this. Are your teams in here? Investment teams. All right. Okay, so team one, I'll give y'all BBBY, the firm. I have no idea who they are. Team two, what was the second one? Be okay. Well, that worked out really well, didn't it? All right, so that works, doesn't it? And the next one was KMX. KMX is very interesting given what used prices did. Then we got Delta. Y'all okay with Delta and that team? Then we've got what? Goldman Sachs. You want Goldman Sachs? All right, interesting firm. And then we got, I don't know. Oops, I'm already there. AX, you know who that firm is?
No.
All right, so you're gonna learn a new company here. I mean, this is the place, if I were putting something in my portfolio, I think global payments is an incredible area to be. I would find a firm that is gonna disrupt this industry radically because I think PayPal charges way too much for their services. And I think credit cards charge way too much for their services. Then we've got Thor and USB. I think Thor is really interesting right now. I'd imagine they benefited dramatically from the prices. And then the banks, USB is a bank that reported good numbers and their stock price tanked. That's always interesting to me. So you got to do some research. Why did the market react negatively to a bank that reported really good numbers? That's kind of interesting, all right? And so Thor is selling RVs. That's pretty interesting. Let's see how their earnings did. It should be interesting to see. So they're doing pretty well, aren't they? They went from $2, they went from 43 cents. So pre-COVID, you know, $1.50 was a pretty good, and then look at COVID. So would you have thought that, let's say it's 2019, we're gonna have a major market crash next year, one of the worst drops in GDP numbers we've ever seen. We're gonna shut down our economy. How many of y'all would recommend Thor stock in that scenario? A firm that produces this major durable good called the RV. You probably say, oh yeah, avoid that stock, right? Go to short that stock. And how do they do? Their earnings tripled, quadrupled. Really interesting stuff. How did the stock market react? That's the other thing you got to see. The stock market doesn't always react the way you think, but here they reacted pretty positive. The stock was up over 10%. Pretty crazy stuff. I've always wanted to do one of those RV vacations. I think it'd be pretty cool. Rent a dog and put my bike and just travel across the country. But the things are ridiculously expensive, just renting them. And then gasoline, you'd end up being better off just flying first class and staying in 5-star hotels. You'd spend less money. So I'm like, yeah, I'm not going to do that. That sounds crazy, but there are people that like doing that. So, and here's a firm that surprised by 12%, and their stock fell 3 or 4%. So as a finance person, what are you thinking? I got to figure that out. Why in the world did that happen? Because that wasn't true with Goldman Sachs, right? Goldman Sachs beat and their stock went up. So it wasn't like all banks fell. So why did Goldman Sachs go up when USB went down? Boy, it's curious, right? He's like, man, I got to figure that out. That's pretty amazing. All right, so everybody knows what they're doing. Anybody miss which company they're doing? Yeah, got it. Avi, which company you doing?
CarMax.
CarMax, good. Oliver, all right, y'all got it. Okay, good. And you got the data here. Do you have to restrict yourself just to this spreadsheet? No, you can do whatever you want to go do. Bloomberg is a great resource. You just click in your company on the news and the AV, go click on the date that reported earnings, and you're gonna have all kinds of articles that come up and you can email them to yourself. It's just, there's a lot of resources you have available to you. All right. And we'll do, before it's due, we'll do a smaller group meeting. A lot of students missed the one before exam 1, and it kind of showed. I was tempted to do students that missed versus students that came. You think there'd be a great average difference in those exams? So here's your chance. We're gonna walk through each one of your companies, make sure you have the right data, make sure you're comparing to the right thing, you got the right dates. If you miss that, then it's probably going to be reflected in your score. I will probably show you an example paper, maybe on Thursday, but I'm not going to put an example paper on Blackboard. Every time I do that, about 20% of the class load that paper and edit it for their company. It's like, I can't think, I got to use somebody else's brain. I'm just going to edit there. And I was like, no, you can't do that in finance. You can try that in your first job. Boss, you want me to do research, but I don't know how. So can you give me someone else's research and I'll just edit it? It's not going to work. That's not how finance works. Finance is, you got to figure it out on your own. So come up with your own stuff, write about it. Don't be the students like, what do I do next, professor? What do I do next? You got to figure it out. What makes most logical sense to do next? All right. Someone came in a little late, I think. Anyone here that I don't have? Mitchell, Carlos, Edgar, Garrett. I thought I saw Garrett. No.
Yeah.
Oh, you're online. Adriana. Okay, that's probably who I was thinking of. Adrian. Olivia. That's another one. I knew I saw somebody. Akash, he's online. Oh, Garrett, you are here. Sorry. You even said that.
Yeah.
And I thought I was hearing it from the speakers. So okay, sorry. When you get old, Akash is online, Joshua, Kevin, Alvaro, Eric, the other Eric, Laura is online, Julian, everybody else? Okay. All right, so what we want to do today is we're going to talk about measuring risk and spend a lot of time here on beta. If you took my 3013 class, there's some repetition here. Hopefully you remember it all so you can help us out on this. Right, so the main things you're going to use are standard deviation, beta, correlation, R squared. You need to be backwards and forwards knowledgeable of those four things. All right, you should know them absolutely, what the formulas are and what the formulas are measuring and how you use them. You use these formulas, I don't know how many millions of times over your career. It's just going to be massive. This is extremely important in finance. So when do we use standard deviation? Standard deviation is also known as total risk. So when you're trying to assess the risk of a portfolio, standard deviation is the number you want to use, right? And as we said, it tells you how far can you get from the expected value. That's how we measure risk. We don't measure risk as how much can you lose. It's how far can you get, whether positive or negative. It's a symmetrical thing. It's very sensitive to outliers. So we're going to skip much more on standard deviation. We're going to focus now on individual securities. So standard deviation is not the right measure for individual securities. So if you're trying to figure out, wow, how should I value Uber stock? I was listening to a podcast on Uber today. Very, very interesting. Made me want to go buy some Uber stock. It was really interesting. They're making a strong case for Uber. But if I'm trying to figure out, hey, I need a discount rate for Uber, I can't just look at the standard deviation of Uber's stock price, because standard deviation would overstate their risk. Because there's a lot of their risk that's going to disappear as soon as I stick Uber into a portfolio of 80 or 90 stocks. And so William Sharp, y'all heard of him, right? Everybody has to know who William Sharp is. I've only seen him once in real life. He came here to San Antonio, even spoke. Very impressive guy, and that was probably 25 years ago, and he's still heavily involved today. He's known as the father of modern finance. He's also the one who really got computers going in finance. He writes some really good articles. You can go to his website. And I showed you one of his articles earlier in the class. He came up with the capital asset pricing model, or CAPM. He won a Nobel Prize for this. It's supposedly, last time I saw an article about this, supposedly the most referenced article ever written in the history of finance. A pretty important article. And what he said is, when you add a stock or stocks to a portfolio, a big part of the risk completely disappears just because of their diversification. Because he says stocks have two risks. The total risk of a stock is systematic risk plus unsystematic risk. Systematic risk plus unsystematic risk. Systematic risk is measured by beta, but beta is a relative measure. So that's really, really, really critical. On the exam, you do have one essay question related to beta. I'm real picky on beta. So get this in your notes. I see students with nothing to write with and nothing to take notes with, and it's like they're telling me, this professor will never say anything that's important to my life. So, and that may be true, but you should at least pretend. So this is really, really important on the exam. You cannot say beta is a measure of systematic risk, because that's not true. Beta is a measure of relative systematic risk. See what word I have underlined? So if you leave that out on the exam, I'm going to count off because it's really important. So if Apple has a beta of 1.2, we don't say Apple's systematic risk is 1.2. We say they have 20% more systematic risk than the average stock. What is the beta of the average stock? It's 1. So if you have a beta of 1.2, you have 20% more systematic risk than the average stock. All right, any questions on that word relative? That needs to be in your answer, definitely, on any definition of beta. And it's relative to what? The beta of market. So what is the market? Well, for some reason, it's the S&P 500. I don't know why they picked that. The S&P 500 is not the market. It's only about 85% of the US market. but we use beta. And that's why I don't like CAPM's title. You look at the title, it says capital asset. Capital asset is what? Stocks, bonds, real estate, commodities. But what do we use CAPM for? Stocks, right? So that's wrong. It doesn't give you a price for anything. It gives you a discount rate so you can price something, but it doesn't price anything. It gives you a discount rate to price stuff. And it's not a model. What is it? It's a formula. But other than that, it's a really good title. So it's the stock discount rate formula. I don't know what that spells. Doesn't spell CAPM. But this is what he said. You know, you can take this. This is the only risk that's relevant. There's other terms for systematic risk, but one of them is relevant risk. What's the risk that's relevant, which implies other risk is not relevant? It's also known as market risk, systematic risk, systemic risk, however you want to pronounce it. Relative to the market, which is a beta of 1. And then you have unsystematic risk, also known as company-specific risk, idiosyncratic risk. I like to use idiosyncratic because it just sounds more impressive in an interview. But these are risks that are specific to the company that if you have several companies in your portfolio, these risks disappear, completely disappear. I don't know if y'all remember from last class that we calculated the R squared of our company versus the S&P 500. Y'all remember that? We got like 30%. I don't know if I kept that. Let me see if I kept that file. No telling where I would have filed it, so as usual. Here we go. No. So last class we had IBM and the S&P, and remember we did the beta of IBM, we got 1.07, and then we did the correlation of IBM to the market, and we got an R squared of 36%. And what do we say that meant? Anybody remember? 36% of IBM's risk is it systematic or unsystematic? This is the R squared to the market. So which is this, the systematic or the unsystematic? It's systematic, which means IBM in a well-diversified portfolio, you will see how much of the stock's risk. So 36% of their risk is systematic, which means if you put IBM, the stock of IBM into a well-diversified portfolio, what percentage of the risk of IBM stock is going to completely disappear? 64%. That's pretty amazing, isn't it? How did you eliminate 64% of your risk? You just made sure you stuck IBM in a portfolio that had a whole lot more other stocks. All right, so pretty radical thought that he came up with. So that R squared is actually a pretty powerful number. How stable is it over time? Well, in normal times, it ranges for most stocks around 15 to 25%. During a crisis, it tends to jump up, which means what? That diversification benefit works really well in normal markets and doesn't help you so much in a crisis. It's just the opposite of what you'd like. You'd like diversification to help you more in a crisis, but it doesn't. All right, questions on this? This will be an exam and questions, so I want to make sure everybody's really comfortable. How do you word this? The beta is one of those things that, in fact, when I was interviewing finance majors, that was one of my favorite questions. Discuss beta. I love 2-word questions. Discuss beta. I'm tempted in my risk management class on the final, just to say risk management with the question mark. And just tell me everything you've learned in the last semester. I like that kind of just open-ended questions. Probably 97% of the time, I would get horrible answers. I remember my boss was like, "Oh, you got to interview this guy. He's an MBA from Yale." I go, "Okay, I'll interview him." Finance major from Yale. And boy, he must be really smart. He had no idea what beta was. It's like, okay, you're not just undergraduate, graduate, and graduate school. You don't know what beta is. How could you get that far? All right, so systematic risk for most stocks, the majority of the risk is unsystematic. Maybe for all stocks. So most of the risk of a stock is unsystematic, which means diversification is powerful, reduces your risk quite dramatically. So what is William Sharp saying? He's saying systematic risk is the only relevant risk. And so when you come up with your discount rate for your stock, you should only consider systematic risk. You completely ignore unsystematic risk because you can eliminate it so easily. And beta is a measure of what? Relative systematic risk. Y'all remember the formula for beta? Covariance over the standard deviation of the market squared. Y'all remember that? All right. What is the beta of your portfolio? So you talked about this on exam one. You're expecting a recession. What do you want to do at the beta of your portfolio? Increase it or reduce it? You expect a recession. You want to reduce it. So how do you know if you reduce it? Well, you sell your betas that are above one and you buy stocks with betas that are below one, and that's going to reduce your beta. So beta is really simple. The beta of a portfolio is just the weighted average betas of your individual stocks. That's a piece of cake. Really easy. I like that. Duration is the same way. The duration of your bond portfolio is just the weighted average duration of your individual bonds. So I like that. That is not true of standard deviation. The standard deviation of stock portfolio is not the weighted average standard deviations of your individual stocks, because a lot of that standard deviation is going to disappear. So the beta portfolio is the weighted average beta of each stock. If you have a beta of the portfolio of 1.2 and you expect a recession, the lower beta, you sell your higher beta stocks and you buy lower beta stocks. Now that may not have worked too well in 2019 because you might have been selling Thor and buying, gosh, I can't think of a low beta stock that did horribly, but you know, it may not have worked because 2020 was such an unusual recession. Certainly selling your Carnival Cruise Line and your Delta Airlines would have done well. So if you can, and remember this, diversification doesn't reduce your unsystematic risk, it eliminates it, completely gets rid of it. So what William Sharp is saying is, if you're taking unsystematic risk, you better know what you're doing, because you're not going to get compensated for that in the price of the stock. The market will not compensate you. So you say, hey, I only have one stock in my portfolio. It's Zoom. And, you know, based on that, I look at its volatility. Man, my portfolio is really volatile. So I think Zoom stocks should be trading for like 73 cents. So you call your broker and you say, hey, I want to buy more Zoom stock for 73 cents. And your broker says, yeah, you're not going to do that. I don't know what Zoom's trading for right now. I haven't looked at Zoom in a while. Oh, come on, UTSA. It's a gift for me. I'd have to give it with a gift, whatever it was. All right, come on. I love having a football team in the top 20. I just wish we had bandwidth in the top 20. That'd be kind of nice. All right, somehow I'm not in Yahoo Finance. I don't know where I am. All right, so all this just to get a stock price. All right, maybe we can be that low. Maybe you come up with $23. So you call your broker and say, hey, I want to buy some more Zoom stock. I value it at $23. And your broker's like, well, yeah, you can put in a bid if you want to, but it's not going to execute. So why are you getting $23? Well, I'm using a 43% discount rate. And your broker's like, why are you using such a high discount rate? Well, I looked at the standard deviation of Zoom, and based on that, that's the kind of return I need to compensate me for risk. Well, The average investor, Zoom is not their only stock. They're not looking at Zoom as the standard deviation, and just looking at a systematic risk, which eliminates 60–70% of that risk. So they're not using a discount rate in the 40s, they're using a discount rate of like 9–10%. And so they're getting $278. So if you're going to buy Zoom and it's going to be your only stock, you're going to pay a whole lot more for it than the risk you're taking. So you better be absolutely sure what the stock is doing, or you're going to be grossly overpaying. So, so the relevant risk, the systematic risk is what you want. We talked about that being covariance divided by the standard deviation of the market squared. In Excel, you use the slope function. And so we'll show that as we do this in Excel, you'll see how you use that slope function. So for individual bonds, how do we do that there? For individual bonds, none of this we just talked about applies on bonds. I know that he called it the capital asset pricing model, so it sounds like it would apply to bonds and real estate. But with stocks, you have the most you can lose is 100%, and you have unlimited upside. With bonds, what's the most you can lose? 100%. What's the most you can make? Your coupon, right? You can't, the bond's not going to go up 100%. So if you got a bond paying 6%, what's the most you can do? You can make 6%. So there is no upside skewing. So with bonds, you know, beta assumes it's nice symmetrical, but with bonds, it's not symmetrical. There's 100% downside and there's very limited upside. So CAPM does not apply. So we use duration, convexity, credit ratings, all that stuff we talked under with DC cuts I for bonds. If you take John Tui's bond class this next semester, he'll go through all of that. How do you bring that into a bond analysis? So doesn't really work for real estate either. So the capital asset pricing model really is a stock only. And it definitely doesn't work for options, because options actually use standard deviation in the price, because it's a very different type of security. So he needs to rename his model. All right, so how do you come up with betas? So we're going to look at beta. One of the biggest challenges with betas is that they're very, very unstable over time. They're just all over the place, up and down, up and down. And much more unstable than the theories suggest they should be. Because the firm's not changing its business like that, and yet the beta is going like that. But most of your finance classes, they're going to use a regression beta, and I'm not a regression beta person. Some of the other professors are like, why do you do it like that? But I just don't believe in regression betas. So I believe beta is a forecast. It's not a number you look up. It's a forecast, just like growth rates. So when you do papers 3 and 4, on paper 3, you got to come up with the beta for your company. In paper 4, you got to come up with the growth rate for your company. I'm going to give you some ideas how to do that. But anytime you're talking about a forecast, there is no obvious way to do it. Every forecast is unique. Anytime you're projecting the future, and I've had students ask me that on paper 4, how do I get my growth rate? Well, you got to predict the future. Where do you go to predict the future? That's reliable. There's no place to go, is there? So it's your opinion, your ideas. There are models and ways we can do that. Most of those are heavily reliant on the past. There's a great article out there I really, really love by, let me actually show it to you just a second here, because I do love this article. You might not believe this, and I can't confirm it. James Montier is one of my favorite writers. He works for GMO now, so if you go to GMO and register, you can get your hands on his articles. But he did an analysis of forecast growth rates in the past for companies. And what he discovered was there was a 98 correlation, 0.98 correlation. Is that pretty high? What's the highest you can be? 1, so you're pretty high there. between past growth and forecast growth. So what are analysts doing? Wow, Zoom's grown 30%. I think they're going to grow 30%. Campbell Soup's grown 0.1%. I think they're going to grow 0.1%. What does the next sentence say? And a negative 0.9 correlation between forecast growth and actually delivered growth. That's what score would you give these forecasters? I mean, F would be a little too good, wouldn't it? And he actually did a chart that I really like. So here's value stocks. You remember value stocks? What do you know about value stocks? Low earnings, low growth. Here's your growth stocks. So you notice value stocks have lower earnings than growth stocks. The next bullet is what analysts forecast. What do you notice? The higher growth firms had a higher growth forecast. Lower growth firms had a lower growth forecast. What do you notice about every single sector? The analysts expected better growth. Isn't that crazy? They took firms with really great growth and they said it's even going to get better. That's a pretty tall order for management. But here's the realized growth. What do you notice about the value stocks versus the growth stocks when it comes to realized growth? They actually did better. That's pretty amazing, isn't it? So where was the forecast the worst for growth stocks? They expected better growth and it came in well below, and there's almost a perfect correlation. You may know what this is called. You may ever heard of reversion to the mean, right? Isn't this reversion to the mean? Well above growth had below average growth had above average growth. This is the industry you're walking into. We're not good forecasters. So beta is the same way. Beta is a forecast, so you have to come up with it, and there's no obvious way to forecast beta, but I'm going to give you my approach. If you took my 3013, so you get to see this again. I used to think this was just my approach, but then I noticed Dr. Demandaren does the exact same thing, so I feel more comfortable with it. So if you're going to forecast the beta of your company, there's 4 things you got to look at. The first one is focused on revenues, which is the business that they're in. The next 2 are focused on, wait, where did I go here? Wait, something's wrong with my notes here. Sorry about that. Should have checked that in advance. Where's my other steps? Step 2 is way down here. I don't know why it's there. The second thing you're going to look at, the next second and third thing you're going to look at, the leverage, operating leverage and financial leverage. And then the last thing you're going to look at is history. All right. So on the exam and on paper 3, you'll have to do this. You're going to talk about the firm and its revenue. You're going to assess their operating and financial leverage. And then you're going to do a historical chart, and you have to put the historical chart into your paper 3. You have no choice on that. I'm going to force you to do it. Y'all remember this from 3013, or does that seem like too many years ago? It was only a semester ago, right? All right. I think I flipped to the wrong page. But, all right, let me jump. I'm going to jump to the forecast. So I'll come back to those other notes later. So I want to get into this so that you can start thinking about this. So you're going to come up with the forecast of a beta for your stock. The first thing you want to ask is, what kind of company is this? Is it defensive, or is it cyclical, or somewhere in between? You remember this from paper 1, exam 1, right? We already talked about this. Where did my companies go? All right, so Bed Bath & Beyond, cyclical or defensive? So how do you define that? The way I define that is a firm is, since it is cyclical, if their revenues are going to fall more than an average company in a recession, They're defensive if their revenues will fall less than the average company in recession. So you have a recession, is Bed Bath & Beyond going to feel that more painfully than the average company or less? You could probably argue either way, but I would probably say more. My guess is people go to Bed Bath & Beyond because they want something a little bit nicer. But if they're worried about their job, they'll probably go to Walmart, maybe into the dollar store, right? How much of Bed Bath & Beyond can you buy from the dollar store? So I would guess they would be cyclical, but you might be making an argument. BlackRock. All right, what is BlackRock's revenue? It's a management fee times assets. What do assets do in a recession? They go up in price or come down in price? Come down in price. If your entire revenue is a management fee times assets, what is your revenue going to do in a recession? You're going to fall a bunch. So that would be a high beta company. CarMax. In normal recessions, should be a cyclical company, right? I know 2020 was a little different. Delta Airlines, definitely a cyclical high beta company. Goldman Sachs, that was a little trickier. They do manage an asset management, but they're primarily a net interest margin type of company and a trading company. Trading revenues can actually go up in a recession because everybody's selling their stocks and they're making the trading revenues. So it's Goldman Sachs is a little bit tougher. In 2008, what did Goldman Sachs do? Crashed, right? But 2008 was a financial crisis. If you're a financial company in a financial crisis, you're going to crash. Did they crash in 2000? No. What crashed in 2000? Tech stocks, right? So you can see why beta is not stable at all over time. Paychecks, I don't even know what they do. I don't know if they're, I think they're business to business, aren't they? So integrated, and I love that word, integrated human capital management solutions for human resources, payroll benefits, insurance services for small to medium size. That's pretty important, right? Small to medium size are going to do what in a recession? They're going to get much more harmed. Now, it's a little tough here because small to medium sized companies, they may be cutting staff during a recession, but are they going to cut paychecks during a recession? So you know what, we got a recession, we're just going to stop paying our employees. Probably not. So it's a little tough to know on that one. That one might need some research. We can look at the historical beta. The historical beta is below 1, but that's just for what? The last 5 years. So we'll have to figure that out, right? You would think paychecks would have done badly last year if they're that sensitive. So it's not always obvious. That's one that you'd have to do some thinking about. Thor, what is Thor traditionally? Obviously cyclical. They sell these, what, $200,000 houses on wheels. And again, another bank. Banks are a little tougher. Obviously would have done badly in 2008, but banks are a little bit unusual. So it's not always obvious. Some of these are pretty obvious. To me, BlackRock, CarMax, Delta, Thor, those are the obvious cyclical ones. We don't really have any obvious defensive companies in the stocks we're doing for paper two. What would be an obvious defensive company? Walmart, definitely. So it's probably incumbent waste management. I never, well, waste management, what is that? You have a recession, does your community cancel their trash pickup? Hopefully not. Walmart, definitely low beta, not that low, but a low beta company. Another one? Yeah, Coke, maybe, we'll see. They're showing a low beta here. Probably it's a low cost item, right? And it's people tend to buy it, but yeah, probably, I don't think it's a 0.64. Now, Kroger, you would think it'd be low beta, and it is here, but we're going to talk about leverage. Kroger has a lot of debt, so how are we going to use that to offset this beta? Any obvious high cyclical companies? Tesla? Tesla might be a little strange. Come on, you can do it. What a gift. I just want you to work. Yeah, that does make some sense, but they've actually done fairly well at times when everything else is going badly and then badly when everything else is doing well. So it's a little tough. Now you might say, well, that's unsystematic risk. What are you talking about? Well, you have to be careful on beta. If a firm has a really big day on a day when the market has a big day, but they have a big day because of unsystematic things, beta can interpret that as a beta. So beta can be fooled by unsystematic things. So it just depends. So some of this is just pure random type of noise. So beta is pretty unreliable. It doesn't really look at just systematic things. It tries. All right, so that's your goal, is to try to figure out your company. Is it defensive or is it cyclical? So what I strongly recommend you do on paper 3, and this one I'll see who's paying attention because I really look for this, where I count off a lot of points on paper 3 is students to go through these 4 steps and their final beta recommendation completely ignores what they just did. So what I recommend you do before you come to your final conclusion is to do a table that shows revenue sensitivity, cyclical, beta of this, operating leverage. Here's my high operating leverage, beta of this, financial leverage, highly levered, beta of this, history recommends this, and your overall. So you can prove that you considered those 4 things in your final recommendation. So that's how you can lose a lot of points on paper 3. So you go through this process and then you just ditch it and you just go with the history and go, say, well, their historical beta has been about 1.5, so I'm going to use that. Well, is that consistent with what you said about revenue, about leverage? So you've got to connect them. Putting a table, a summary table, helps quite a bit. You can somewhat think about beta in terms of sectors. So the consumer discretionary, just by definition, is a high beta company. Anything that's consumer discretionary, so Bed Bath & Beyond, we kind of think of that as a consumer discretionary, not a Tesla, so it's maybe not a 1.9, but it may be a 1.1. Consumer staples, by definition, are low beta companies, defensive companies. So that's pretty straightforward. Materials are high beta companies. Concrete still, because they're going into production and production cuts back. Industrials, almost by definition, are high beta. So if you can do Packard, makes diesel engines, that's going to be a high beta type of company. Healthcare, we tend to think of healthcare as low beta for 2 reasons. First, if you break your leg, you're probably going to get it fixed. You're not going to say, you know what, I'll wait till next year, make sure I don't lose my job first. You're probably going to get it fixed. But number 2, you're not paying for the bills anyway, right? Garrett's having to listen to that in my life insurance class, right? We've been talking about that. The problem with healthcare is that people that use the service don't pay for it. But what is healthcare tied to? It's usually tied to employment. So that gives it a higher beta. So that can be a little tough. We talk about financials. Financials are a little bit tough. Information systems and technology have historically always been thought of as cyclical high beta, but that's starting to change more now because it's becoming such a big part of our lives. Real estate's almost always high beta. Kind of depends on which real estate you're talking about. Utilities, almost always low beta. If you're going to lose your job, you're probably going to keep your electricity. You're not going to let that go. Energy is a little tough. People tend to buy gasoline even in a recession. So that's one of the reasons the Fed doesn't get so worked up about high energy prices, because they know people, and high food and high energy prices, because they know people are going to keep buying energy and food and they're going to cut back on everything else. So high energy prices, high food prices tend to be deflationary for everything else. So people tend to do that, but who knows? And then communication services, who knows? Facebook, what is Facebook going to do in a recession? So where does Facebook's revenues come from? Ads. What do firms do during a recession? They tend to cut back, but I'm going to guess most firms are going to cut back on print and TV before they cut back on Google and Facebook. But they'll probably cut back some, so it's probably a little bit higher beta. But the other thing in communication services are the telecoms. Telecoms historically have been low beta companies. Are you going to cancel your AT&T plan if we go into a recession? Probably not. You need your phone, but so some of these are a little bit more difficult to guess than others, but there are traditional ways we think about these, so I gave you more of the traditional ones. All right, questions on that? That's pretty important for your paper 3, that you define your company very, very well. There's no math to do here. I've had some students go back and look at previous recessions and see how the company did. But remember, there's a lot of unsystematic risk. So just because a company did really well in 2008 doesn't mean they're low beta. It may mean they announced some new product that year and they just happen to do well that year. So you can't always go by that. It's true Walmart has done extremely well in the last 2 recessions. Part of that was in 2008, they're definitely a defensive company. But I think 2020, there was more going on than just them being defensive. I think it was people cutting back their restaurants 90% and substituting groceries for that. And I think that could have some impact on that. All right, y'all got that? I'm going to let you pick your own company for paper 3 and 4. You have to do the same company for 3 and 4. The only rules are you want a company that has positive earnings, pays a dividend, unless you absolutely want to do a company not paying a dividend, you have to come to me and I'll help you out with that. But there aren't too many restrictions on that. So if figuring out what kind of firm your firm is bothers you, then pick one that's really obvious, that you know is a cyclical or defensive, and that will make it easier to do. Like Campbell Soup. What is Campbell Soup? Cyclical or defensive? Defensive, right? When's the last time you heard someone say, man, I'm worried about losing my job? We're gonna have to cut back on our Campbell Soup. We just can't take chances with these high costs. No, it's not gonna happen, right? That's probably what they're gonna be buying a bunch of. All right, the next 2 are leverage. And there's 2 leverages, and you make sure you really understand these. It's really interesting today listening to a podcast on Uber. Well, they spent a lot of time talking about operating leverage. Huh? That business breakdowns, I love so much. Yeah, they got Uber. It's a really good podcast. They'll have you out there buying Uber stock. He picked 2 people who love Uber stock. They also like DoorDash, and so they were really, really pushing those. I think DoorDash looks awfully expensive to me, but Uber, I can see that argument. But they talked a lot about, Uber is coming out of this crisis. Obviously, last year was a disaster for Uber, but they're coming out of this crisis, and their fixed costs are actually at a point that when they come out of this crisis, they're going to see a huge increase in their earnings. So what is operating leverage? It's your fixed costs and your cost structure. Why is fixed costs important? Because the more fixed costs you have, the more volatile your earnings are going to be. So if you have a lot of fixed costs and your revenue falls 5%, your earnings are going to fall a lot more than 5%. So firms with a lot of fixed costs are going to have very high betas. Firms with very low fixed costs can have low betas. Now, you got to think about number 1 and number 2 together as a combination. So if a firm is a defensive company, this will probably not take them from a 0.6 beta to 1.4. What high operating leverage will do will push them closer to 1. Right? So if you're a defensive company that has high fixed costs, you'll probably move up closer to 1. You won't necessarily jump above. If you're a cyclical firm with low fixed costs, it's not going to drop you from 1.5 to 0.8, but it's going to drop you down closer to 1. All right. So these type of things, or if you're a cyclical company with high fixed costs, it's just going to push you up higher. All right. So what operating leverage does is it kind of scales your beta, but keeps it somewhat in a general area. Where do fixed costs come from? Where if you have salaried workers. So pharmaceuticals are a good example. Pharmaceuticals can be considered low beta companies because it's healthcare, but they also have heavy salaried employees. They hire these scientists. And if you're a pharmaceutical, you're going into a recession, you're not going to fire your scientists. That's central to your business. You got to keep paying these people. You can't lose them. So you're going to have that fixed cost. You just got to keep paying for it. Unionized workforces like GM. GM has a huge contracts where they got to keep paying workers no matter what's going on. And that gives them a huge, and probably even bigger for General Motors and Ford is their pension plans and their health plans. Ford and GM have a lot of workers that are retired or on sabbatical, and they have to keep paying for their health care and their pensions, no matter what happens, that's a fixed cost that just doesn't do anything for them. If they have a lot of property, plant, and equipment, that's going to give you a depreciation expense, which is a very fixed cost. If they got a lot of capital expenditures, a lot of research and development, those are fixed costs. If they have a lot of ongoing marketing campaigns and they just have to spend that every year, that can be a fixed cost. Now, I will warn you, think about a firm like Nike. If you look at Nike, their marketing, yeah, it's pretty substantial, but it's a pretty consistent percentage of their revenues. It tends to go up and down with the revenues. So that makes it what? A fixed cost or a variable cost? Makes it a variable cost. So they do somewhat control that relative. So it looks like you look at the numbers, it's really stable. It looks like they do target their marketing costs as a percentage of revenue. So that's going to take what would be a fixed cost and makes it more of a variable cost. And then the one thing I like to think about is the elasticity of demand. So y'all remember this from your eco class, right? Inelastic products, you raise your prices 5%, so what do your volumes do? They fall less than 5%. That's inelastic. That's what you want, right? You raise your prices 5%, your volumes fall 2%, your revenue is going to go up. If you have elastic demand, what happens when you raise your prices 5%? Your volumes drop 10% or 15%. That's going to really make your beta much higher, right? So tobacco, what's the elasticity of demand for tobacco? Is it elastic or inelastic? Inelastic, right? Right, it's an addictive product. People are going to pay for it no matter what, even with the massive taxes on top of it. So that means if they raise their prices 5%, their volumes probably won't fall that much, and they'll have it. Why would they raise their prices? Well, maybe their cost of goods sold went up. So that means they can control that and keep their margins very, very stable. So you have to think about that. If this firm raises prices, what would happen to its volumes? You know, if you think about Delta Airlines, they raise their prices, and that's what they're talking about, right? Because jet fuel prices are up so much. That's probably gonna have a pretty big impact on people traveling. I was pretty excited when I looked at United's airfare to Costa Rica. I've paid as much as $1,500 for a trip to Costa Rica, and normally it's $500 to $600. They had it down around $300. Okay, that's a pretty cheap flight, but I haven't looked in the last couple of weeks. If they start pushing that up, that could influence whether I want to fly there this next winter break. All right. So question on operating leverage. I'm going to show you how you can actually kind of measure this, but in your paper 3, this is important as well. I'm going to give you a way to somewhat measure this, but you need to have a subjective discussion on operating leverage. What kind of cost does this firm have? All right, and then the third one, we'll come back to that. The third one is financial leverage. That's the simplest one of all, and that's just how much debt they have. So what do you think? High debt would do what to beta? Raise it or lower it? Increases, right? We even have a formula for that. We're not going to use the formula, but we actually have a formula in finance that shows exactly how to adjust your beta for debt. Now this I used at USAA. You'd say, you know, what is USAA's beta? Well, they're not publicly traded, so they don't have a stock. If you don't have a stock, does that mean you don't have a beta? Well, we had to file rates with the states, and they wanted to know our cost of capital. So I had to come up with one. So what I did is I calculated the beta for all of USAA's competitors that were publicly traded. So Allstate and Chubb and all these companies. And I just assumed USAA and all their competitors had the same operating leverage. So where would USAA differ from all these other companies? On their financial leverage. So essentially what I said, okay, let me take all USAA's competitors, figure out what their beta is, and then I'll adjust it for USAA's financial leverage, and that'll give me a beta that I can follow. And the states always took it. I never had the state come back and question me on that. So it worked pretty well. So financial leverage is the amount of debt you have. That's very easy to measure. I'm going to give you a chart that will help you do that. And then the last thing you need to do is history. And you do have to put the history in your paper 3, and I'll show you how to do that. And you'll have other YouTubes that help you do that. Now, this is a typo in the notes. I should have changed this. I used to do 3-year betas using weekly data. Why did I do that? Well, because that's what Yahoo Finance did. Now I use 5-year data using monthly data. Guess why I do that? Because that's what Yahoo Finance does now, all right? So make sure you do 5 years and monthly. I don't know why they switched. The reason I want you to do it that way is if you use that approach, then your very, very last beta that you calculated should match what's in Yahoo Finance. And that way you can check and make sure you've got the right number. You can get pretty different numbers when you're doing 3-year and when you're doing weekly versus 5-year and monthly. It can be radically different. All right, so let's talk these in-between ones, and we'll come back in the notes on Thursday. Operating leverage. Is there any way to figure out the operating leverage of a firm? Well, here's my theory. If a firm has high operating leverage or elastic demand for their products, you should see it in the volatility of their margins. So a firm that has high price elasticity, their margins should be really volatile, right? Because they make a small change in their prices and they see their volumes change a bunch. People are very sensitive to their prices. A firm that has very inelastic demand for their product, then you shouldn't see the gross margins change that much. And then on the net margin, firms that have high price elasticity and high fixed costs should have very volatile net margins. Okay, does that make sense? This is entirely my theory, so you're kind of, risking. I think it makes sense. So what I'm arguing is if we want to try to get some sense of the operating leverage of the firm, let's just get their margins and calculate the standard deviation and see what that is. Okay, and I've given you that. I've got a file. Where is it? I think this is it. No, that's not it. There it is. There's a file out there on Blackboard under the paper 3 help. And let's do a company. What company do we want to do? Let's see. I always like to start with Costco because they're so amazing. I am a huge Costco fan, even though I used to have a membership there, but I got rid of it just because I didn't need 4 crates of olives, but it's still a really impressive firm. So what I did here at the bottom is I have their gross margin and their net margin standard deviations. And there's the standard deviation of the US stock market, and there's the standard deviation of Costco. What do you notice about Costco's standard deviation? The gross margins, incredibly stable. One of the most stable firms out there. They rank in the top 5% of one of the most stable companies out there. Why is it? Well, when their costs go up, they raise their prices. And their customers accept that, right? If coffee prices go up, Costco raises their prices on coffee. Do their customers revolt? No, they know coffee prices went up, so they either buy more tea or they buy, they expend more on coffee. And how many coffee drinkers do you know that say, coffee prices are up, so I'll just switch to tea? Doesn't happen very often, right? So they're pretty addicted people as well. So very, very, very stable. What about the net margin? The market's standard deviation of net margin. Net margins is, I think I use EBITDA over revenue. It's 5.8%. Costco is 0.2%. They're, I would say they're the most stable company out there, but I don't know who is the most stable. That would be interesting to see. Who is the most stable company out there? I should have looked for that. Equal men. Well, it's going to say 0 because I have zeros. So that's probably why they're 0.5. I doubt there's anyone that much lower than them. I mean, how much lower can you get, right? 0.2%. So if you actually look at Costco, here's their net margin and their gross margins, 12. Well, I can give you some decimal places, I guess. 1233, 1248, 1250, 1247, 1231, 1235, 1239, 1272, 1277, 1257. That is absolutely remarkable that they can manage that so well. Could you forecast this company? We're doing that right in my class. What did we pick? I think we used 13% or something. You know, it's pretty obvious what the forecast. What about the net margin? 1297, 270, 297, 276, 288, 282, 271. Amazingly consistent. This to me is even more amazing. I can see gross margins being pretty stable, but net margins being stable, it's just pretty phenomenal. So what does this mean? So Costco is what? Defensive or cyclical? Yeah, definitely defensive. So what are you going to do on the margin side? I mean, on the operating leverage side, is that going to increase your beta or bring it even further away from one? So op margin will reduce beta even further from one. So if you thought their beta is like 0.6, you might drop it down to 0.5 because they're just so stable. All right. What about their debt? Well, debt's a lot easier. Here's the debt to equity. So be real careful on paper 3. I do count out for this. If you say Costco's gross margin is 0.31%, then that's absolutely wrong. This is the standard deviation of their margin. It's not 31%, it's 0.31%. This is the standard deviation of their net margin, 0.2%. But this is up here, this is their actual debt to equity. So the typical stock has a debt to equity of 60%. Costco's at 55%. So for financial leverage, right, with the market, no beta impact. Y'all agree with that? They're pretty much right there in line with the market. They're not excessively high in debt. They don't have really low debt. So that's probably not going to influence my beta assumption. All right. So you can put these into your paper. The gross margin is the harder one to talk about. So if you wanted, you could leave this entirely out of your paper, but you definitely want the net margin in there. All right, let's look at Tesla. Why not? Tesla's a pretty crazy firm. So you can look at the gross margins, 88%, minus 8%, 9%, 26%, 30%, 7%, 23, 28, 23. Are they getting a little more consistent? 19, 19. They're definitely going in on something. So their first few years. So this is probably going to grossly overstate their true leverage. But let's try that TSLA. So their gross margin has a standard deviation of 22%. It looks like the last few years it's been much more lower. They're one of the most volatile. Look at their net margin. 30,000%, whatever that even means. They're one of the most volatile, if not the most volatile. I think that grossly overstates it, right? If you did Tesla, which you really can't do Tesla, it's not a good firm to do. But if you did Tesla, I would probably say, I'm going to look at the last 3 or 4 years because those early years were just a brand new firm getting set up. So I think that grossly overstates it. But that's what you're going to do on paper 3 is you're going to figure out your assumptions for beta for your company. So what we'll do next class is we're going to do the rolling beta for the history, and then we'll go back in the notes and bring in a few more things that we need to consider. All right, that's it for me. So what was the economic numbers yesterday? See that number? 2%, is that a good number? And is that real or nominal? The headline number is always what? Always real, right? You don't report the nominal one. 2% is pretty pathetic for 2 reasons. First, it's pretty pathetic. Secondly, we're coming out of COVID. It's supposed to be like ridiculously strong right now. So that's a scary number. What else we know about that number? It's going to change dramatically because they keep updating it. So we'll probably get higher or lower, who knows, probably higher. But so that's a number you would, if you have an interview this week, that's a number you would want to know. The jobless claims came out today. That would be an important one to know. But When's our next employment report? Next Friday, probably, right? Sometimes it's delayed depending on where it hits, but so that would be an important one. It's funny to me, boy, you listen to webs from the left or from the right, and boy, people pick their numbers, and either Biden's the worst president we've ever had in the history of the world, or he's the greatest president we've ever had in the history of the world, but you can really pick your numbers. I'm not in the camp that believes the president actually influences the economy all that much. We don't live in a socialist country, and actually I think we influence the economy. I don't think the president actually steps out and says, hey, we're going to do this stuff. They certainly have some influence, but what is our Constitution? To whom does it give power over over our economy? Mainly the legislature, right? They're the ones that make laws and rules, but anyway, you're stuck with, the presidents are stuck with whatever they have. All right, so today we're going to spend some time with beta. We're not going to do much with beta right now because we're going to wait and use it when we do paper 3 and 4 and we value stocks, but we need beta to do that. So today I'm going to show you how to do a rolling beta in Excel. Those that had in the 3013, hopefully you remember how to do it. If one of you want to come up and teach that part, that would be fine. And then we'll go back and review the concept of beta and go through that 4-step process. And hopefully we'll get into bond valuation today. I wanted to talk a little bit about the paper. So next Tuesday, we'll do our Zoom sessions. So I'll send that out. So that means you need to write your first draft of paper 2 this weekend. I put the file out there. I updated it. So you've got your companies. So I updated it. You got the same data you had here, but I updated on the graph to give you 2 graphs. So I have the one that includes overnight. See the one that doesn't include overnight? It probably makes a much better paper, like draft of your paper. Don't you think? I always think this is kind of messy because there you got it when the markets are closed. So you look at that and you're like, well, what exactly happened? Well, they're reporting right here, right? So it's a little uncertainty. People are kind of reacting. Plus it's the pre-market, so the market's not even open. So it's the pre-market. So if the market's not open, there's not much volume. It's not a lot of people. And then the market's open, and then there's, people just put, a million share trade, whatever, all these institutional investors, they're moving on the stock. So here you can really see it. There's where it closed. There's where it opened. Pretty obvious the market didn't like that. Versus BlackRock. Pretty messy, right? Previous day. This is during the day. This is after close. This is before open, and then it opens. Or if you look at it like that, it's a lot cleaner, right? You can just tell closed, came up. So you can use either one of those or create your own. The advantage of using Bloomberg, if you're going to put these papers, and this is a good paper to put on LinkedIn, it is impressive to have a Bloomberg chart in your paper, just showing that you know Bloomberg and how to use it. Even though Bloomberg charts are not that pretty, they work well on a paper like this, just to show you know what you're doing, so you have some skills. How else do you handle this? Well, you need to find some articles. This is where students always amaze me. It's like, I couldn't find anything, professor. There's nothing out there anywhere. Well, did you try this? There's article after article after article after article. I mean, it's not that difficult. So there's some students, I'm not real sure when they get the first job what they're going to do. It's like, I don't know what to do. Tell me what to do next. Okay, well, you're researching a report. You got all the numbers. Go find some articles on them. How do you find articles in the Google age? You Google BlackRock earnings announcement, and 2.7 million articles come up. Actually, not that many, because some of those are about previous reports. How many should you read? Well, you keep reading until you got an answer to the question. So I love Seeking Alpha. They do some interesting stuff. Sometimes there's nothing written. Sometimes it's just a number. Beat estimates, the stock rises sharply. BlackRock, oh, well, and sometimes they want to charge you money. The world's largest asset manager reported better than expected earnings. The stock was rising, revenue grew. That said, total assets under management were a little under the estimates. What you're looking for is what? Substance. Okay, so you're going to quote this in your paper. The total assets under management were a little under estimates due to broader market activity. You're going to quote that? That doesn't sound like a very impressive quote. What are you looking for? All right, so remember this paper, always have in context. As a in finance, unlike accounting, I was an accountant for my first 2-3 years of my career. In finance, you're trying to explain why things happen with substance. I remember the first time I present to the president of my company because my boss was out sick. And my report was our revenues are up for annuities. And he's like, well, why is that? Well, because we sold more annuities. It's like, oh, wow, thanks, Ron. That's great insight. We didn't know that our revenues would go up if we sold more stuff. What did he want to know? Why did you sell more annuities? Is there something going on with rates? Is it, teachers coming back to school? What's going on? So you're looking for substance. The latter AUM is reflective of pretty large sell-off. Well, that makes sense. Asset under management. What do assets under management do if the stock market sells off 2%? They're going to fall about 2%. Right? So it's pretty straightforward. But who said this? Some guy at Edward Jones. Well, I don't care much for Edward Jones. I don't know if I like that quote or not. So you're looking for substance. You're trying to explain what is going on. So that is your goal. Think of it in the better context of why would your boss ask this? So you own BlackRock in your portfolio. Your boss says, hey, BlackRock reports before open tomorrow. I need a paper on my desk by 9:30. What's your boss looking for? Well, we own BlackRock based on these assumptions. That are anything in this earnings report that radically changes our view of this bank or this entity? Is there anything radically new and important? Well, the stock jumped about 4%. So the market obviously thinks there's something in this earnings report that is insightful in some way that made them more excited about this company. There was something in BBBYs that did what? Convince people, wow, we got new information. It's probably not good information. Something bad is happening there. All right. So you see what you're after? So to give you a couple examples, here's a paper on Carnival Cruise. Wow, what an interesting paper, Q1 2020. Like who cares, right? Right before COVID shut them down. So they talk about the earnings per share. His paragraphs are a little bit long, but he did a good job. What are you going to talk about? What did they report? What was expected? Top line, what does that mean? The revenue, right? A good quote. Is this a good quote? For the 7-week period, booking volumes for the remainder of the year are meaningfully behind prior year due to the virus and its fallout. Cumulative advanced bookings for the remainder are meaningfully lower than the prior year. Yeah, that's kind of good. You probably could have shortened it down. Bottom line, what is that? That's gross margin, net margin. You're trying to see, is there something going on with the expenses, cost of goods sold that's having an impact? Margin strength, this quarter representing a 56% decline from last year. Then he's going to try to explain it. Management noted that they have a large upcoming commitment in financing cruise ship deliveries. Marketing CapEx reductions preserve liquidity in 2002 costs by laying up ships. So has some quotes in there. So you're trying to have a section to explain it. You can have it a separate section or you can explain as you go. So you do EPS, well, this was off because of this. Revenues was off because of this. Margins, or you can present the numbers and then have a section that explains everything. You have to figure out what makes the most sense. Then the market reaction, you'll always have a chart. But here's where you can be very, very creative. You could do a chart of your company. You could do a chart of, you could do a bar chart of your company versus the market versus its competitors. There's a lot of things you can do here to give insight. BlackRock's a good example. Yeah, it was up 4%, but a lot of financials were up a bunch that week because it was earnings week and JP Morgan. So maybe it wasn't all that impressive. Maybe the whole market's just reacting positively So he has that discussion. What is that? Is that Royal Caribbean? Compared it to a competitor. You could add a chart. No, we're just focused on the day of the earnings, all right? So you don't want to make this a big discussion of the last 5 years or 10 years, but you could certainly do a chart that shows the last year. If I were doing a firm like, like Carnival Cruise Lines, I'd probably go from December 2019 through today. I just want to show COVID and after COVID. How far have they come back, right? So what are you trying to do? You're trying to help your boss understand what's going on with this company, but you're focused on that particular day. But you can always give a wider context to this, to any of these reports. So the S&P 500, and then you can do a final conclusion if you like. All right, so there's one paper. Here's one. An abstract saying what they're going to do. You definitely want to have in your paper a short description of the company. I recommend you don't go to Yahoo Finance and copy and paste the profile because those are really poorly written. So put it into your own words, find some good description of the company. You can edit that one down. Numbers versus estimates. What these numbers mean, that's a good title. Why did the stock behave like this? All right, no graphs. I don't see how you can do this paper without graphs, so he left the graphs out, but he does have some good quotes. And he did a lot better job on the paragraph length, right? You don't, if you're doing, I love the 2 columns, thin margins. If you do that, I wouldn't have your paragraph ever more than 10 lines because it's just too much to read. It's really hard to read long paragraphs like that. All right, so there's one. Here's one on Del Taco. It had a really horrible report. Here, have y'all ever eaten at Del Taco? I'm not real sure if they're any different than Taco Bell. Yeah. I don't understand, man. Taco Bell is all over Costa Rica. I'm thinking, they have some of the greatest indigenous food in the world, and there's a Taco Bell here. It's like, why would anyone? And we ate at Taco Bell once there. I was like, where do I want to eat? We need to grab something. Let's go to Taco Bell. Del Taco earnings per share, revenue growth, bottom line margin. Remember, there's 2 margins. There's gross and there's net. But firms like Delta Airlines, BlackRock don't have gross margins, so you can't do that part of it. He has the quotes in there, some explanations. The market reaction, he has not only does he have a graph, but he puts some text into it to try to explain it, what's going on. I'm not real sure where he got these graphs. That looks like Yahoo Finance. Yeah, so you can get some good graphs off of Yahoo Finance. Here, this is an interesting one. He did Yahoo Finance to do this. Jack in the Box versus Del Taco. Explanation and management comments. So you can do the earnings conference call to do that. If you do the earnings conference call, you may have to actually listen to it. I haven't had good success with the transcriptions of the calls because they do it with computers and there's just way too many typos. But actually listen to it. What do you want to listen to in the call? Well, I would listen to the first 10 minutes and then I'd jump down to the analyst questions because that's really the most helpful. And if you've never listened to an earnings call, do it for this paper. So when you get into an interview, you can say, yeah, I've listened to earnings call. I do it all the time. I mean, you've done it once, but once you round up to all the time, you can kind of be honest about it. Now you don't have to do an outlook, but they're giving you an outlook. If management's telling you something, we expect our overall restaurant contribution performance during the second half will demonstrate our business has stabilized. Okay, that's the CFO telling you something. So management quotes are interesting, but they're biased. So it's good to have a mix of what is management saying, what are outside analysts saying. That's always a good mix of those 2. And then here's one on Ross Ross is an interesting place. Introduction of the company, talking about the earnings. They did a longer earnings trend. You can certainly do that, especially if you want to try to show what COVID, and you have that in the Excel file, right? So you have the comp and the estimate. If you wanted, now they did them both, the comp and the estimate. So, oh, Bill Gates doesn't, yeah, I don't know why they did it like that. That makes no sense at all. I don't even know what they're graphing there. I just highlighted like 100 numbers and they just graphed like 6 numbers. So good job, Bill Gates. I don't know which one I clicked on, but that can be interesting, right? The problem with this is it's going right to left, and I like it to go left to right. So you have to flip it around. I like the earlier numbers, earlier numbers left and later numbers right. But you certainly see COVID in these numbers. Now I told you we don't care about the estimates. Some people like to do these longer, so you don't need to talk about last year's estimate, but some people like to put in a chart just to see generally this firm beats on estimates or whatever. So if that's your argument, it's not unusual for a lot of companies to beat on estimates all the time. That's because management likes to talk the numbers down, like going into earnings season, and then they always report a surprise beat. And that's kind of what they like to do. So, and the market says, okay, we'll bite, we'll reduce our estimates. We don't really believe that. We actually think it's gonna be higher, but we'll put our official number further down if you like. So you can add other things. So what should you add? Would you add anything that gives you insights into what happens in this earnings report? If it doesn't give you insights, then don't put it in there. All right, so those kind of things that you do. Talk about revenue, more graphs. He actually put the chart in on our revenue, so you can do that as well. There's a lot of things you can do. Even did a chart on gross margins. Now here, it's pretty interesting. He's doing the dollars, so he's not doing the EBITDA margin. You could actually do this chart as EBITDA margin if you really know how to work Excel and get it there. In the market reaction, he did the overnight. See how messy this is. So I kind of don't like this chart just because it is so noisy. It's got so much stuff in it. So my preference would do the one that doesn't have overnight, but then to talk to the overnight. So you can say the initial reaction in pre-market was this, that at open it was this, just talk to the numbers rather than actually showing it. And then that other chart that's not so messy will give you a much better picture. Or create your own chart like he did here. He did this versus the S&P. That's pretty interesting. He did this versus TJ Maxx. It kind of helps. Ross obviously has a competitor with TJ Maxx, so that kind of makes sense to do that. I've never been in a TJ Maxx in my life. So just more comparisons. They compared it against the small cap. You can compare it against the consumer discretionary stocks or against apparel stocks. There's all kind of things you can do. We'll talk about that on Tuesday. So he says outlook. Again, you don't have to do outlook, but that's where management will say stuff. With continued rollout of vaccines potential and likely pent-up consumer demand, we expect comparable store sales to strengthen as we move through the year. That's interesting, but their estimates no better than anybody else's. Just because they work for the company doesn't mean they know people are going to suddenly have pent-up demand and combine stuff, but it's nice to know they're positive. How often is management positive in their earnings announcements? Like 97% of the time, right? That's their goal, is to put a good spin and good story on this company. Unless you're Warren Buffett, you're going to try to fancy it up. All right. So if you're like, what do I do next? Well, what you do next is, what does your boss need? All right. That's the critical thinking part of college, is prove that you can actually think about, and on the job, what you're going to do is, okay, my boss asked for this, so obviously I'm going to talk about these things, but what else could I put into this paper that would really put great insight in this company? And the answer to that is whatever it is. It's going to be different for every single company. So you've got to somehow figure what that is. So you might read something, article that says this company has been really hurt by the rising jet fuel prices. Guess what you might put into Delta's paper? Last 2 years jet fuel prices with the graph. That might be interesting, right? And if you can't find jet fuel prices, put oil prices in. So yeah, so Delta, I've been hearing that Delta is probably going to be increasing its ticket prices because of the rising oil prices. If that's in your paper, then having a chart that shows that might be pretty insightful to your boss, don't you think? That might show them something. All right, y'all got it? This is kind of fun. I'm kind of jealous of y'all. Y'all get to write this paper. Okay. So what I want to do is I want to talk about the rolling beta first. I'm just going to do it. So to do a beta, remember beta is a measure of systematic risk that we're going to compare your stock behavior to the market. So that means we need your stock prices and we need the market. So where can we get that information? All right, I've been looking at Uber, but Uber doesn't have enough history. So I'll do Walmart, which is the one stock you can't do for papers 3 and 4 because it's my example stock. Although I always type Walmart and almost always get Waste Management, but that time it worked. So I'm in Yahoo Finance. You click on historical data. Go back as far as you can. Yahoo Finance has changed their system, so it actually only goes back to 85, but that's fine. But you just do the max, right? Tell them you want the max. We want historical prices, although for paper 4, you might do a dividends only because you actually need the last 12 months of dividends. And Yahoo Finance no longer shows that on the summary page. So that's an easy way to get their dividends, but we're going to use historical prices. And what do we want? I've moved from weekly to monthly because Yahoo Finance has moved from weekly to monthly. So we're going to do monthly, but weekly's fine, daily's fine. One thing that bothers people is you can get radically different betas whether you use weekly, monthly, or daily data, and that shouldn't be the case, but it is. I've seen some firms that it changes quite dramatically. So you apply that, then you download it. And so we're going to use adjusted close. So you can get rid of everything. But remember I said, well, if you want, well, I think this is the confusing part of the semester. I have another class that's almost at the exact same place you are on betas, so I can't remember. So if I explain something I already talked about last class, or if I jumped something I didn't explain last class, you can say, wait a minute, what are you talking about? Or why are you telling us that again? So bring in the close and adjusted close. We want to actually use the adjusted close. However, we're going to calculate our beta at exactly the same way Yahoo Finance does, but I'm pretty sure they use the close. So what you can do is calculate it twice, and your last number should match Yahoo Finance, and then you know you have it right, and then you just flip the adjusted close and you'll be fine. All right. So you'll see how I do that. So there is a Walmart. Why are we using adjusted close? Because if they pay a big dividend in a month, it's going to make their stock price fall, and that's going to make it not match what the market's doing. And we don't want that noise from the dividend because we know that's totally, completely unrelated to what's going on with the company, especially from systematic risk. All right, so now we need the market. So there's 2 ways to get the market. You can just click on S&P here. However, if you do this like at 7 a.m. or 6 p.m., this may not be S&P 500. It might be the futures. So how do you find the S&P 500? So I'm already in here. The best way to find it is just do Shift 6 GSPC, and that will give you the S&P 500. All right, so that's another way to get it. And the nice thing about doing it here is if you do it here, then you've already got everything you need. It's already monthly. It's already going back the same period. Now you notice one thing, and I hate this, but I don't know why they made this change. Notice there's no download button. Isn't that irritating? So what do you have to do? You can copy it. That's the way I do it. There may be another way. If I knew Python, I could do it. But you just have to highlight. It doesn't take that long, right? It's not like weeks and weeks and weeks. So you just copy that. And we're going to paste it in here as text. Oops. What happened? I don't know what Bill Gates just did there. All right, which one do we need? Adjusted close or close? It doesn't matter because this index is a price only index. There are no dividends, so we don't have the dividends. Plus, it really doesn't matter because it's the S&P 500. Companies are paying dividends all throughout the years, so it's somewhat masked in the numbers. What else do we want? We want it to go from youngest to oldest. So I'm going to resort it here. So there we have it. Does it line up? January 85, January 85, October 21. That looks pretty good. What I'm going to do with October, zap it because we don't have October yet. All right, so we got the S&P 500. I always title that SPX because it's kind of fits. All right, so now we need some holding period returns. Do you remember how to do a holding period return, right? Anybody remember the formula? Off the top of your head. I was going to give you some examples from the exam. I'm going to wait until after this class next Thursday. Hopefully I remember. But I wanted to get this done because we're in the middle of it. Off the top of your head, you got to do it on exam, so you might as well learn it. Also, this formula is on the FAC exam if you haven't taken that yet, but I assume you have if you're in here. So what's holding period return? Someone give it to me. Just yell it out.
Ending market value minus beginning market value, then plus.
All right, yeah. And which one of those can we ignore? Accrued income because it's already in the adjusted numbers. All right, so let's do it. We can't do a holding period return for the first month, and why is that? There's no beginning market value, so we can't do that. So the second month, ending market value, I'm going to do it on close to start with, and then we'll adjust it. Minus beginning market value divided by beginning market value. And for some reason, it's 0%. I don't know if that's a rounding thing. It's not because these are both 142, because they go out many decimal places. It may just be pure coincidence their stock started in it, and that's possible. It doesn't look possible when you're out that many decimal places, but the actual stock price was like $43.22, and it's possible that number didn't change. All right, so there we have that, and then there's the well, that's not the S&P, but here's the S&P. There's the S&P. So we got the two. Let's copy this down. So what we're looking for is when Walmart's above its average, is the market above its average. When Walmart's below its average, is the market below its average. So right here, what do you notice? Walmart's well above its average. The market's well above its average. Same thing here. Same thing here. Here, not so much, right? Here we got a month where Walmart's above its average and the market's below average. So what kind of beta we're going to get? It's going to be hard to guess just from the numbers. So here we're going to do the rolling beta. And we're going to do just like Yahoo Finance, 5 years using monthly data. So how many months in 5 years? So go down 60 months. There's 60 months right there. So we're going to start 60 months into this. So we want to know what their beta was for the 5 years ending January 1990. All right. Anybody remember the Excel function for beta?
XPV or no, slope coral.
Not coral. We're not doing, it's slope. Yeah. The slope. Now you have to do your company first and then the market. If you do the market first in your company, you got an upside down number. Why is it? Because it's dividing by what? The volatility of the market. But if you put your company first, what is it going to do? It's going to divide by the volatility of your stock. So you can get a really crazy answer if you do that. All right, so there's the number there. Now that looks really, really high for a beta for Walmart, but for Walmart, when they were a much smaller company back then, smaller companies tend to have higher betas than larger companies. So they were still an up and coming company back then. All right, so we'll copy this down and we'll go look at the very last number. The very last number is 0.5. So what should we see in Yahoo Finance? I go back to Yahoo Finance, go to the summary. Oh, I don't have Walmart anymore. So summary, and what do they show for the beta?
Waste management.
Oh, I did it again. Boy, I can't wait till UTSA purchases bandwidth. It'd be really nice. What beta did they show there? 0.5. What beta did we get? 0.5. So that gives you great confidence. Now, how many betas did we calculate? We calculated 381. How many betas is Yahoo Finance giving you? The very, very last one. All right, but we don't want to use adjusted close. I mean, we don't want to use close. We want to use adjusted close. So I'm going to change this formula to use adjusted close. When I do that, what happens to my beta? It goes to 0.51. So when you use adjusted close, you'll be off a little bit, but it won't be radical probably unless your firm has some radical dividend. All right, so use adjusted close, but if you want to check against the close, you can just to make sure you've got what Bloomberg has. All right, so there's our number. So I'm going to look at this. Some of y'all may have the same issue that I have with Walmart, is when I look at Walmart's chart, I'm seeing two companies. I'm seeing small cap Walmart and I'm seeing big cap Walmart. And so when I look at this, I might say, you know what, I'm just going to show these years, or I want to show central tendencies, but from this right here. So I'm going to see that's about 0.178, or right back here. This is where it really starts to change, 0.180. I'm kind of curious where 0.180 is. So I think when I do my numbers, I'm going to start at 2004. But you can't do the entire period, but I think with Walmart 2004. So if you see a graph like that, where it's definitely real high in one period and real low in the next period, you might want to change it. If you're doing a tech company, if you have the 2000, 2001 .com busts, that might give you a radically different beta versus a more current. So I'm gonna do it from 2004. So what do we want to do? So we want to have some data here. So I'm going to bring in the median, the 90th percentile, and the 10th percentile. But when I do the median, you use the function percentile. Y'all use that before. I love the percentile function, percentile. But I'm not going to start from here. I'm going to start in 2004. Good chance with your company, you'll just do the entire period. But for Walmart, I'm going to start in 2004 all the way down. I want to lock that in, comma, 0.5, lock in the row. So the median is 0.35. I think that's too low for Walmart. I wouldn't use a 0.35 for Walmart. If I use 0.35 for Walmart, I would have a lot of Walmart stock, because that's going to give you extremely high valuation. But there's the median, there's the 90th percentile, which is also pretty low. There's the 10th percentile. Right, so I can copy that down. What's another formula we could have used for beta? Anybody remember that one? It's covariance divided by what? Standardization of what? Yeah, so of the market. And it's the standard deviation of the market squared, right? It's the volatility. Oops. Bill Gates. So we got our company, we got the market divided by let's see if we get the same answer or not. That looked pretty close. So that's the other formula, right? Is covariance divided by the standard deviation of the market squared. Why do I like that formula? Well, what's the numerator for correlation? Exact same number, covariance. But what do you do in correlation? It's covariance divided by standard deviation of the stock times the standard deviation of the market, whereas beta is just the market. All right, see how these formulas are so similar. All right, so now we can graph this whole thing. And you can see now my lines are really focused on this part of the graph. All right, so I'm saying, okay, it's a small cap company. We know small cap companies, their betas come down as they get larger and larger. So when you get to paper 3, you're going to want to have a base case beta, a high case, and a low case, and this chart might help you do that. I don't believe that low case is just way too low. What else am I missing here? Well, obviously, I need some dates. And what's wrong with these dates? Well, I don't really care what month it is, right? That doesn't help me at all. So I'm just going to use the year. So here I got the years. I got the beta. Anything else we need to fix?
Yes, the titles. on the
Titles.
bottom.
All right, so do we have to say, do we have to put axis labels on this one? We don't. It's pretty obvious what the y-axis is. And once our title is up there, we'll know what the x-axis is. So we're going to say Walmart rolling beta. Cap lock. Walmart rolling beta. 5-year rolling data. So we got a title. Anything else we need?
Yes.
So the legend. Oh, Bill Gates, come on, man. Gotta do better than that. All I want to do is grab that and move it up. All right, so let's fix that. So that's Walmart rolling 5-year rolling beta. That's the median. You don't have to say Walmart median or 5-year rolling. You know, you can just say the 90th percentile. And I don't really care if the 90th percentile is the top or the bottom. You know, you can. It really doesn't matter. Percentile. So that's the graph that needs to be in your paper 3. It's a big chunk of your paper 3 grade. So if you don't have it in your paper, you'll lose a lot of points. Try to spell the word rolling correctly, but other than that, it's a pretty decent looking chart. All right, clean it up, make sure everything's showing and all that kind of stuff. All right, so that to me is a really, really insightful chart. Now, what do your other finance professors have you do? Well, this is what I usually see. Have y'all done this before? So that's a pretty common approach. So what's their beta? It's the slope of that trend line. But what does this chart tell you? I don't think it tells you much. It gives you a beta for the entire period. We know the beta for the entire period is wrong because we saw two different companies. That's why it's beta for the whole period is 0.74. But that 0.74 is really, it's 20 years where it was above 1 and then 20 years when it was below 0.6. So which of these dots are the 1.3, 1.4, and which of these, to me, it's just a glob of data. So I don't care for this chart. I've had a professor ask, why do y'all do these rolling betas? That seems so stupid. And I was like, well, I don't know. I didn't say, well, I think what you're doing is stupid. I didn't say that, but I said, yeah, I don't know what you're getting, what insight you're getting from this glob of dots. So just tell me the slope. Don't give me the glob of dots. Just tell me the slope. That'd be good enough. But I don't like this chart. Doesn't help me. Now I have some students that just can't follow the instructions here, and they'll go to, there's some web pages that'll do something similar to this, and they'll put that in their paper. I'll give you some credit for that, but not much. There's absolutely no reason you can't build this in Excel. All right, any undergraduate finance major should be able to sit down and handle an Excel assignment, because you can sit there. I've got several videos that show you to do this in addition to this class. You just follow the instructions and just do it. All right, so if you weren't keeping up with me here, you can watch the video again and do it on your own. So there's no reason you shouldn't be able to do that. Now I might take out some of the white space here. I don't like a lot of white space, so I might take that to 1.4. I tend to start at 0, but it's possible if your firm's just way up there, you start at 0.5 or something, so you don't have a whole lot of just noise there at the bottom. But with Walmart going down to 0 makes a lot of sense. All right, so that's what I mean by rolling beta. Any questions on that? So your other finance classes won't do that. I think you should still do it, even if they don't ask for it, because I think it's much more insightful. All right. So let's look, just make sure we understand betas. So there are two risks in any stock. When you combine them, it's called total risk. Standard deviation is how we measure total risk. So how would we measure total risk for Walmart? Real simple. You just go to the returns and just do equal STDEVP. That's their monthly standard deviation. How do you annualize? I may know how to annualize a monthly standard deviation. So this would be wrong, multiplying by 12, but what would be right? Not divide by 12. I'll give you a hint. You can annualize volatility, but you can't annualize standard deviation. So if this was volatility, we could multiply by 12. So instead of multiplying by 12, what would we do? So volatility, standard deviation is what? The square root of volatility. So instead of multiplying by 12, multiply by what? How about the square root of 12? All right, so you annualize standard deviation by multiplying it by the number of time periods in a year raised to the 0.5. So Walmart's standard deviation is 22.62. The stock market is 15%. So if we use standard deviation, Walmart looks more risky than the market. But we're going to use a beta of like 0.4, 0.5, which is it's half as risky as the average stock in the market. You notice we're going to completely ignore standard deviation. That's another good number to know. The standard, I gave y'all earlier the daily standard deviation of the stock market, which is about 1%. Here's the annual standard deviation of the market, about 15%. If you go back to the Great Depression, it jumps up to 19%. And then you have some big days like October 87, I mean, big months. Like that, right? 21% drop in a month. If you take that 1 month out, it has a quite significant impact on our standard deviation. So do you want to leave that month out or not? So, I'm leaving it in there. But now, some people say don't use STDEVP, but use STDEV. It's going to give you almost the exact same answer. Because instead of dividing by n, you divide by n-1. When you have 300 and something months, it doesn't matter. So on something like this, I use STDEVP because it makes you consistent with all the other calculations. So you don't have kind of competing numbers. All right. So we can calculate the standard deviation of Walmart stock, but William Sharpe is saying that's not a relevant risk for them. Why? Because Walmart may have its really good months when everything else is crashing, and it may have its really bad months when everything else is doing well. So that means it's going to diversify your portfolio. Standard deviation doesn't consider that. It just looks at how volatile it is. So William Sharpe says we need to separate total risk into two risks: systematic risk and unsystematic risk, or company-specific risk. Systematic risk is how sensitive your company is to systematic events. The most important one is the economy. If you go into a recession, is this firm going to react more than the average stock or less than the average stock? So cyclical and defensive. There are other systematic risks that impact firms differently, like inflation, interest rates, geopolitical events, like COVID. So, and that's one reason why companies' betas are not very stable, because banks are very sensitive to interest rates and bankruptcies. Oil stocks, energy stocks are very sensitive to energy prices. These are things that are on different cycles. So it's possible a tech stock's going to see their betas shoot up during the dot-com bust. Bank stocks see their betas shoot up during the 2008 crisis. Those are all systematic risks, but they affect. So essentially what beta is saying is systematic risk, they're the same over time. And you can just measure that. But no, some systematic risk have more impact on some stocks than others. So we talk about beta being a one-factor model. All it looks at is the stock market as your input. And what I'm arguing is that's just not enough. There's a lot more other factors out there that have different impacts. Every stock is exposed to systematic risk, but at different levels. Some stocks have high systematic risk, which makes them cyclical. Some stocks have systematic risk, but it's very low, it makes them defensive. So we talked about it being a measure of relative systematic risk. There are other models out there. So arbitrage pricing theory, it used to be known as the bar model, after I forget the guy's name, but he got bought out by MSCI. Y'all have heard of them, right? We talked about MSCI, Morgan Stanley Capital Indices. So I don't know if I can, let's see if I can get that in there. It won't let me click on it because it's not really there. MSCI factor story, y'all remember that? SCI.com, was it backslash? What was it? Factor story. What chance do I have of actually getting it right? Looks like it's there.
I think it's a dash.
Oh, factor story. Oh, I thought I did a dash. I just hit the. So factor, what that means is, what are your inputs trying to figure out the risk of this company? Some of y'all may have heard of the Fama French model. You might see that in some of your classes. So they do have this out there. They used to have the bar model. They bought the bar model. It's the most famous factor model out there. Before they bought it, you used to be able to go out and get all the factors for the bar model. We could look at every single one of them. One of them was cap weight. So small cap versus large cap. That was one of their inputs. But they don't do that anymore. So once he sold out the MSCI, we don't have that. So, but factor models. So they won't give you anything, right? They want you to buy their product. So if you bought this product, you would be getting different discount rates than if you use the capital asset pricing model. The big question is, do the people buying these models have better returns than the people who don't? Does it add any value? Are they getting what they're paying for? I don't know if there's been any studies that show that or not. They do have it. There we go right there. This is a new thing they've added. This is pretty, I don't want to, don't do that. Oh, I had it and I lost it. Where is it? Okay, here we go. That sound familiar? Growth versus value? That's a factor. What are we looking at? Cyclical versus defensive, but they say also do growth versus value. But we know about growth versus value. It has a correlation to defensive and cyclical, right? So cyclical companies do better in strong economies. Value companies do better in strong economies. So there's some overlap. Small caps, large cap, does that have a correlation to cyclical and defensive? Small cap do well in strong economies, large cap don't. So you can see there's some multicollinearity going here. Momentum, stocks that are rising tend to continue to go up. Stocks that are falling keep to go down. Dividend yield, volatility, quality. So there's volatility. I just said ignore volatility. But they're saying Walmart's 22% standard deviation is actually a factor you should consider. All right, well, there's something. Dividend yield, quality. We already said there's a high correlation between quality and value, right? Value stocks are what? High quality or low quality? Low qualities. So there's some overlapping stuff here. Growth, liquidity. There's their factors. Our factors in the capital asset pricing model is only one factor, and we're using the market to capture all of that stuff. The stock market itself, is that sufficient? Does that work? I can't prove to you whether it does or not. So what is this? It's just a bunch of data mining and statistical analysis to try to figure out. Well, I'm glad they added this back in. They used not to show that. It's pretty cool. They do have research and insights. So if you want to go find more stuff to read, you know, you could go there and see what they have. I don't know if it's any good or not. All right, so we tend to teach CAPM as if it's the only thing in existence, but there are other models out there. So these arbitrage pricing theory models, you know, they're pretty academic, but people do use them, especially hedge funds. There's a lot of hedge funds that have factor models, and not only do they have factor models, but that can actually show you which factor is working and which factor is not working. They'll have it all lined up for you. We talked about that. So we already talked about that. Beta range is unlimited. It's not that hard to create a 1 million beta. You would just borrow a lot of money and stick it in call options on the S&P 500 and you'd have a huge, huge beta. But they tend to range from 0.4 to 3. 0.4 for grocery stores, 0.5 to 6 maybe for utilities or whatever, but and then 3 for, you know, very, very consumer discretionary or industrials. So you can do it by regression, which is what we just did. That's a regression beta. We did it on a 5-year rolling, but it's much better to think of beta as a forecast, not a number you looked up in Yahoo Finance. It's a forecast. Why? Because beta is very unstable. If you use Yahoo Finance, you're just looking at one beta for one 5-year period, and that's all you've got. That doesn't look like much. All right. Unsystematic risk. These are the company-specific risks. These are the risks that William Sharp is saying you can completely ignore. And I agree with him. You can. My problem is systematic risk. Systematic risk, I don't think accurately captures systematic risk because there's so much going on. But a CEO dies, a new product. What do you think Berkshire Hathaway's stock is going to do if Warren Buffett suddenly drops? It's going to go down 5%, 10%, 20%. They're already preparing that already, and they've got a pretty good replacement in mind that the market loves. Is it possible the market wouldn't react at all? That'd be pretty surprising, right? So it's probably going to react. It seems like Buffett's doing pretty well, pretty sharp guy, but he's also what, in his late 80s or something. So it's pretty obvious.
Super terribly treated?
Huh?
Doesn't he eat super terribly treated?
Well, he drinks like a cherry Coke every day or something. Yeah, he doesn't look all that healthy, but I don't remember if he's a cigar smoker or what, but new products, new markets, competitor does something, new drugs approved, you have some disaster. We can ignore all of those. Why? Because when one firm gets great news and other firms can get bad news, they'll just offset each other. It doesn't really matter to your portfolio. We ignore these because it's not that they can be reduced, it's that they can be eliminated. We can actually completely get rid of them. They go to zero. Where do they go zero? Somewhere around, it depends. It really depends on what market you're in, but somewhere around 15 to 25 stocks. If you have 15 to 25 stocks from all different sectors, your unsystematic risk will probably be right at zero. You won't have any at all. How would you know? Well, you take that portfolio, run it against the S&P 500, and what number would you look for? How do you know your unsystematic risk is zero? Y'all remember from last? I'm always curious if y'all were with me last class. R squared, right? Your R squared should be what? 100, right? So you would know that. That was how what would tell you. So there's no adjustment for this. What does that mean for private companies? I mean, this is a huge, when you look at these theories, I love the way William Sharp talks, because when he does a theory, he writes a theory, he writes a paper, he does the analysis, but then he asks the question, what would markets look like if they applied my theory? I think, wow, that's pretty, that's the way to do it, right? Does it make logical sense? So what does this mean for HEB? Well, HEB is a private firm. So that means the Butt family has no diversification whatsoever, right? They're fully, they can't diversify that. There's no way they can, right? It's a huge part of their wealth. So what is their discount rate going to be? They're not going to use capital asset pricing model, right? Because they can't diversify. All those unsystematic risks mean a lot to them. If Walmart starts taking over their market share, that's going to kill them. You can't say, well, I'll have Walmart in my portfolio and HEB. You can't. None of you have your HEB in your portfolio except for the Butt family. So they can't diversify. So that means their discount rate is not going to be 6-7% like you'd expect for Kroger's. Their discount rate is going to be 20, 25, 30%. So what does that mean for the Butt family? Maybe Farrah, you can ask them this question. Why hasn't HEB gone public? As soon as they go public, that day they go public, the Butt family goes from having a net worth of 500 million to a net worth of like $4 billion.
So I'm gonna throw something out there. HEB does technically have like a little stock market, it's public partnership.
Yeah, but it's not publicly traded.
Yeah.
So
I can do that.
as long as the Butt family has 80-90% of their wealth, their value of HEB is going to be probably 70-80% below what it'd be worth if they went public. There's incredible stress to go public. The fact that the Butt family hasn't gone public either means they just don't want to deal with that and they're so rich they don't care. But once you go from 10 butts to 50 butts, as they keep going grandchildren, guess what the pressure is going to be? So you're telling me my net worth is 10 million, but it could be 120 million and we go public. What would you recommend if you were one of those butts? Why don't we go public, guys? So my discount rate can go from 25% to 6%, so I don't have to worry about all that. Yeah, that's, Mark Zuckerberg went through this. He didn't want to go public. I don't want all that hassle, but he did want to be a billionaire. So he said, you know what, I guess I'll do it. All right, so this has huge implications. It's the driving force for why firms want to go public, because it reduces their discount rate. When you reduce the discount rate, the value goes up dramatically. I've seen this exam question on some exams. It does not make sense to say stock betas rose in 2008. I haven't seen that on an exam. That would be a really errors. So people say, wow, we had a recession in 2008, so betas rose. We know that's not true. Why isn't that true? The beta of the market is always what? Always one. So if bank betas go up, what has to also be true? Non-bank betas must go down. It has to be the case. But what did go up in 2008? or what fell in 2008? The R squared fell in 2008. So what does that mean? That means diversification effect was not as good as it used to be. So stocks certainly moved more together in 2008, but their betas, you can't say the betas went up. The beta of the market is always 1. But this one I have seen on the exam, your stock has a beta of 1.1 and the S&P rises 10%. What did your stock do? The answer is, I have no clue. If beta only covers 20% of the stock's risk, there's an 80% chance the market was up 10% and your stock was down 30%. I mean, that's perfectly possible. Now, I have seen it with the portfolio. Your portfolio has a beta of 1.1 and the market goes up. That's getting a little closer where you expect your portfolio to be up 11%. But even then, there's still a lot of noise. But if you've completely eliminated all the unsystematic risk, then yeah, for a portfolio, your best guess would be 11%. It could be 12, 13, 14, or 8 or 9, but it's probably going to be more in the ballpark. But with the individual stock, knowing the beta of your company does not make you better at forecasting your company going forward because there's just so much noise. All right, so I do have videos out there and you have this class video now. Just be careful. Some of my videos do 3 years with weekly, but because Yahoo Finance switched from weekly to monthly, I now do 5 years monthly. When they did 3 years weekly, Walmart's beta was going really negative. And that's the impact of going from 3 years to 5 years. So Walmart's beta didn't get quite so sensitive to that. All right, so how do you forecast it? We already did this. First, decide what kind of company you have. Is it defensive or cyclical? I showed you that last class. Then we talked about the leverage, operating leverage, financial leverage. I listened to a podcast just yesterday and they spent a lot of time talking about the operating leverage of the firms. Yesterday it was a recording studio. The day before is Uber talking about operating leverage. Then look at financial leverage and then look at the history. And remember what I said at the very end, have a summary chart. So make sure you cover all 4 of those things. Otherwise, you're going to lose some points. All right, so what we're going to do. All right, so what we're going to do with beta is we're going to put it on the shelf. And then when we come back to talk about papers 3 and 4, I'm going to actually do entire paper 3 and 4 in class for Walmart, which means you can't do Walmart. I probably won't assign companies for 3 and 4. You'll have to pick your own company. But I'll do go through the entire process step by step. So if you want to take good notes, not be on your iPhones and I still don't understand students that don't take notes, but take good notes. All right, so now what we want to do is talk about bond valuation. So we don't have much time, but let me just introduce it. You should have done this in 3013, so you already know. So for a bond, you borrow, someone borrows money from you. We're going to assume they borrow $1,000. All right. So we call that the face. And there's going to be a coupon. What does the coupon tell you? It's contractual. It tells you exactly what the cash flows are. Okay. What do we assume? Now I saw on the FAC exam, they don't do it like this. I'm not sure why they don't do it like this. The FAC exam assumes that coupons are paid annually, but we know in real life, when are they paid? It's every 6 months. So we're going to assume it's paid every 6 months. And then you have, oh my word, the current yield, which is not a good term. It could be the yield of maturity. It could be the IRR. What we're looking for is the discount rate that equates this bond to its current price. Okay, I don't like current yield. It's a very, very bad description. So yield of maturity is good. What else could it be? What is YTW? Anybody heard of that one? If you want something to Google. Or someone said something, what, any guesses? Yield to worst. So that'd be a good thing to Google and look at yield to worst. What does yield to worst mean? Well, I'll give you a hint. For a treasury, yield to maturity and yield to worst are exactly the same. For a callable bond, yield to maturity will be higher than yield to worst. So does that help you any?
But the worst yield you could get.
Worst yield you could get if management repay the bond in their best interest and your worst interest. So they say, what if they called the bond back in 2 years? What if they call it back in 3 years? What if they call it back today if they could? Yield to worst is they look at every single possible thing that management could do, and it's the worst possible yield, because that's probably what you're going to get, right? The worst case for you as an investor is what for management? Their best case. What is management going to do? Things like, yeah, we should call this bond, but it's going to hurt our investors. We're not going to do. No, they're going to do what's in the best interest of the stockholders, which is to rip off the bondholders. So we want to worry about that because we're not going to do any callable bonds. Okay. So let's say our yield is 6%. What is the price of this bond then? It's real simple. You've got a bond paying 6% and the current market rate is 6%. What would you pay for a $1,000 bond whose coupon and yield are exactly the same? I'd pay $1,000. What if your yield is 4%? You got a bond that's paying you 6%, and the best thing out there that you can get is 4%. Would the person that owned this bond sell it to you for $1,000? They got something paying them 6%. If they sell it to you and get the $1,000, what are they going to go invest in? 4%. How are you going to induce this person to sell you that bond? You got to pay them a premium, right? What if this bond's yield is 8%? You got a bond paying 6%. The current rate is 8%. Would this person sell you that bond for $1,000? Absolutely. Because what do? They'll turn around and buy an 8% bond, and they're going to be better off. How would that person get you to buy their bond? Give you a discount, right? All right, so you can use the PV function if y'all remember that, right? 0.04. How many periods do we have here? I haven't told you that yet, but if it's a 10-year bond, we'd have 20 periods. And the payment, what's the payment? $30. What's the future value? 1,000. So that will give us the bond price. The problem is you can't do that on the exam. Even if your calculator will do that, you're not allowed to do that on exam. So I won't let you get away with that. Why? Because we just proved that Bill Gates knows how to price a bond. Do we care that Bill Gates can price a bond? When you interview for your job, is Bill Gates going to be there with you? You got to do it yourself, right? So the fact that Bill Gates knows that value bond, we don't care. It's not impressive. So we're going to actually price it ourselves. So let's get the time here. Let's say this is a 5-year bond. We're going to do this a little more complicated when we get into it. I just want to set it up. So what we're going to do in this class is I'll do it real quick just so you can remember how to do it, and then we'll do it again. I'm also going to calculate duration because I was going to show you duration. So this bond pays interest in 6 months, in 1 year, 18 months, 2 years, all the way out to 5 years. So how many payments is he going to make? 10 payments. What's my cash flow? $30. How did I get that? 6% times 1,000. That's $60. But I get paid twice a year. So I get paid 30 and 30. How often do I get paid $30? 9 times. What I get paid at the very end? 1,030, right? I get my face back. What's my discount rate? Well, we got to use the effective yield. I'll talk about that some, but the effective yield is, since it pays twice a year, you take the current yield, divide by 2, raise it to the second, minus 1. So we'll come back to that. So we take 1 divided by 1 plus our effective yield raised at the time. Gives me my discount rate, my discounted cash flow, just multiply across. You're not gonna be able to keep up with me. Even though I'm much slower at Excel than you guys are, you still won't be able to keep up with me. So what is my price? Just the sum. My discounted cash flows. Let's see if Bill Gates, whoops, oh, that makes sense. Minus PV 0.04, 0.02, sorry, comma. My number of periods is 10. My payment is 30. My base. Pretty close, right? And what is my duration? We're out of time. I'll show you duration. So we're going to do this all over again next one. I'm just setting up that you should already know how to do this. I'm just setting it up again.